Joining me now is financial expert, hedge fund manager, writer, speaker, and pretty decent skier for his age, Thomas Landstreet. Tom, I see nothing good on the horizon. I'm sorry to be a pessimist. I know the stock markets are at record high, and I'm involved in that. And when there was that dip back in April of 2020 and the panic over Corona, I was saying buy, buy, buy. And obviously that was a good time to buy. But this euphoria that's happening in the markets right now overall seems to be a party that maybe is built on some sort of foundation that is less than solid, less than concrete. Would you agree with that overall?
I'm afraid so. I too have one foot on the accelerator and then one foot on the brake. Yeah. We've seen this before, this scenario. This is a very frothy and speculative market. When you see stocks go up 10, 12, 14% on a decent number, you're in trouble. The old days, unfortunately, I have muscle memory from decades and decades in the industry. When you put up a great number as a good earnings number as a company, the stock would go up 2.5%. That was a huge day. Not anymore. It's 14% on average. And so this is a wildly speculative market. And you always see this type of speculation before a calamity. And it literally every time in history, including 2008, 1999, even in January and February of 2020 before the pandemic. So yes, the behavioral characteristics of this market exhibit a tremendous amount of risk.
So when you say you have one foot on the gas pedal and one foot on the brake, I love that analogy. But to break it down, that is, hey, if you're invested, you better keep an eye on what your investments are, and you better keep an eye on the environment, and you better be involved in your investments. Would that be pretty much what you're saying?
Well, I think so. We could wake up one day and we're down 10%. And if you have all these growth stocks, you could be down 20. And you just don't want that. And so, there are a bunch of really amazing macro economists that I follow, a number of which, there's a guy named Lacey Hunt. You can go Google his work. It's tremendous, very thoughtful, PhD. And if you were to buy this market today, Graham, at these levels, your projected yield on that investment 10 years out is flat to negative. And the reason is because of the valuations you're buying it at. Remember, GDP hasn't really grown much in a decade. So, and yet the market's up 350%. You're paying so much more for so much less. And so your expected yield on that investment today is a lot lower than historic averages. So yes, be very careful here. I like value stocks. I'm kind of inclined that way because I just don't want to wake up one day, like I said, with the market down 10 and me down 20. I'm going to do everything in my power to avoid that. There are times to have your foot on the accelerator completely. And I think you have to have some stocks, obviously, that keep going up, and you'll miss out if you don't. But be prepared. Maybe take 20 or 30% off the table right here. So if we do have this hiccup, you got buying power.
I think that's great advice. And another thing to keep your eye on is precious metals, and maybe we'll speak to that in just a moment, because I know that's in your wheelhouse. But inflation, we haven't seen, quote, inflation per se. And the Fed does this victory dance, Jerome Powell, and before him, Janet Yellen. And Janet Yellen is now in charge of the Treasury. What's the difference between the Treasury and the Federal Reserve? I don't know anymore. I don't want to get down in the weeds in that too much. But the bottom line is, inflation is being held right in check in that 2% range that the Federal Reserve wants. But meantime, gasoline prices are starting to go up. I'm seeing people all over the country saying, what is going on with gasoline prices? I'm reading today that now there are real signs of inflation, but we've been talking about signs of inflation for years now. Is inflation almost a non-entity in this? I know we have inflation, but the way we read inflation seems to be kind of cockamamie and artificial.
Well, the CPI is a bogus statistic, is what you're suggesting. And right. So when they come out with CPI and the market reacts to it, to me, it's just not real. And a couple of reasons is, one, they're not measuring the true basket of goods, like 10 different items and what those same items cost this year versus last year versus the year before. They're adjusting. So let's pretend that steak is up 50%. Let's just pretend. They're going to assume you and I, the consumer, actually don't buy steak, and we adjust to, we substitute out a steak into chicken. And so they make a downward adjustment in steak based on their expectation for us to start buying chicken. So it's not a true measure. I mean, that's just not. The other one is 29% of the CPI, Graham, is a survey. It's called owner's equivalent rent. I think we've talked about this. They call homeowners and they ask them, what could you rent? This is homeowners, not landlords. So of course we are calling an unprofessional audience here. And they ask the homeowners, could you rent your house for this month versus last year? Well, even I, who spent my life studying the markets, would have an incorrect or let's say unscientific answer. Right. If they happen to call my sweet wife, who's smart as a whip, she would have even less so of an unprofessional answer. She might look at my mortgage, and if she's bullish, add $100 to it. If she's bearish, subtract 100. In other words, it's a joke. Right. And yet it's 29% of the CPI. Yeah. So it's like China's economic statistics. The market reacts to them, but they're not real. So eventually, though, Graham, reality matters. And right. It matters when it's too late.
Yeah, reality. And speaking of artificial, interest rates, I'm one of those people that in my first home I bought was looking at double-digit interest rates. That's how long ago it was. And I did an adjustable rate to get it down in the single digits, but it was a high single digits. That was back in a time when we had the Reagan administration. We had a guy named Art Laffer, who you know pretty well. Governing a lot of what was going on in this country. And interest rates, I think back then, were allowed to float, if you will. Now they've been artificially low for what? More than a decade. I went into the bank the other day to try and look at a CD. It wasn't even worth putting your money in a CD. You got the same 0.5% interest rate at just putting it in a regular savings account as a CD. Artificially low interest rates were, I think, possibly you could make the excuse for it when there is an economic calamity underway in 2009 or during the short period of this pandemic. But to keep them down this long, what kind of damage do you think that is doing overall to our economic picture?
Well, initially, it isn't damage. The market is a reflection of those interest rates and that easy money. It inflated the capital markets. When the Fed buys treasuries, which is how they are monetizing our debt, essentially. They're injecting trillions of dollars of new money into what? The capital markets, because they're buying them from banks, the money center banks. And so it goes right into, let's call it the artery. And the artery is the capital markets. And they expect that then to go through the veins and the capillaries out to the average household and so forth to basically get out into the economy. But it's first reflected in the capital markets, which is stock prices and bond prices. So in other words, securities. And boy, have we seen that. So what does it do? It also incentivizes debt creation.
Yep.
And we've seen an unprecedented amount of that. And the reason I have my foot tapping the brake is because I'm fairly freaked out by the just sheer level of debt in the system. When I say the system, and we've talked about this in the past, was that coming into the COVID crisis, 60% of the companies that make up the NASDAQ index had junk bond rated debt, and it's much higher now, Graham. In fact, the amount of debt issued just this year is at a record already this year. And so systemic debt, meaning corporate debt plus government debt. We all know that with if the stimulus package passes, we'll end the year with $6 trillion annual budget deficit, which has to be financed through what? Treasury issuance. Right. So the Fed's going to have to buy those treasuries. They can't let rates increase. If they do, this market collapses. If the market collapses, the economy collapses, because the market is why the economy is strong.
One of the reasons why interest rates can't go up now at this point is, and this is the problem, we're painted into a financial, economic, and fiscal monetary corner. They can't go up because we won't be able to service the debt, would we? If interest rates were allowed to float to where they should be, I don't know where they should be, let's say 4%, 5%, that debt service on the public side of the debt, not even talking about the private. When you say collapse, I know you're probably thinking more private debt, that they're not going to be able to make their loan payment, right? And on the private sector, but also on the public sector, we're talking about squeezed on both ends, are we not?
Correct. So the government itself, let's pretend that the 10-year Treasury bond goes to the interest rate that it had achieved right before COVID. With the new debt that the federal government has taken on, if those rates went back again to pre-COVID levels, the amount of interest, annual interest that would be added to their obligations is almost $1 trillion.
Hmm.
So they can scarcely afford that on top of all the debt they already have to service. So again, they're in the corner, just like you said. If corporate debt rises, there are a lot of zombie companies out there, a record number of zombie companies, which, by the way, is defined as companies that do not generate the cash flows to actually service their debt. In other words, to pay the interest, much less the principal. Then you've got the government debt and the fact that you'd see government debt, the debt costs go up almost $1 trillion. They're stuck. And they're going to continue to try to mollify the markets by saying, yeah, well, we'll rate, we'll taper, which means tighten, and we'll get there, and we're not worried about inflation. We're going to let inflation run hot, and they're saying all that. And for now, it's happy talk. But I think that this bubble is so inflated tight. It's like a balloon, Graham, that's overinflated. It can brush against the carpet and pop loudly. We're there. And that's what worries me. I mean, maybe I'm old fashioned. I'm not at the casino like most people today. I'm outside with the car running, trying to escape.
Well, another potential bubble, and I don't know if you think this is, I'm just trying to square what's going on in housing. So we go from interest rates to housing because obviously they're closely linked. The government, in its infinite wisdom, has granted 180-day forbearance. You don't have to pay your mortgage for 180 days. All right. Well, we're right around the 180-day mark. I know that some readings of foreclosures are up, but again, you have this forbearance, maybe a delay of execution, not a stay, but a delay of execution. And maybe we're going to start seeing some foreclosures increase here. Yet, on the other hand, the housing market in some areas is on fire, in particular in some areas in California, of all places, that's been hammered by the government response to the Wuhan coronavirus. And inventory is extremely low in some markets. But I also know that many people, because they're paranoid about the Wuhan coronavirus, don't want to put their house on the market because they don't want people inside their house. So how do you square where we are with this housing market and where it goes in 2021?
Well, first off, there's a paradigm shift in the way people want to live. And we all thought that people would be migrating to cities. And how many developments there were that were mixed use, where you could shop and eat and work and live in a single community in an urban environment. And that was the rage and that was the future. And now that's totally been reversed. People want out. They want out of the city for obvious reasons. And they want to move to places like Colorado, where I am today, thankfully. And then my hometown of Nashville, Tennessee, which is booming, of course. Yep. But I will tell you that there are some risks, clearly. But you know what? There's an undersupply of housing, because after 2008, with the huge increase of housing stock from 2006 to 2008, when that bubble burst, the housing developments collapsed, right? So we just didn't have enough houses to keep up with the supply of new households. So there's still a supply-demand issue where demand outstrips supply, generally speaking. So in that way, it's still a little bit healthy. The other thing is, household balance sheets, Graham, are surprisingly strong.
Are they?
Way stronger than corporate and government balance sheets. Cash on household balance sheets, equity, because of the rising housing price, of course, the balance sheets are better, but cash. And so I find that actually, of all the bubbles, that's the one I can live with the most, if that makes any sense.
Well, but there's when you talk about your foot on the gas and the brake, before I let you go, I got to ask you about precious metals. Is that on the brake pedal or the gas pedal? I'm going to guess you're on the gas pedal for that, right?
I do own. I have exposure to precious metals equities, which are miners. I'm expecting a couple of things. I would expect that we might get a last surge in this market that's going to be gut-wrenching, shocking. And you see a grand explosion. And I honestly, I kind of expect it this year, but I could be very wrong. There's some people that I really respect who also are looking for that outcome, maybe in June or July, a real meltdown in the market after a parabolic up move, which is often a prerequisite to a blow up. Precious, and then of course I expect the Federal Reserve to jump in bigger than ever. They've already jumped in bigger than ever. Their COVID crisis response was tremendous. They bought government debt, but they also bought corporate debt, trillions of it. They bought ETFs of debt. They've never done that, of course, because it's illegal. They went around that. I won't describe how, but what they've done is unprecedented, and they'll do it again. If the market rolls over aggressively, they will pile in bigger. What does that mean? Well, it means weaker dollar, and I believe we could be facing 70s style inflation. And with a weaker dollar, the best hedge is, of course, I believe, precious metals over 5,000 year history. And the miners themselves, with gold at $1,800, I mean, they're putting up, this is earnings season. They're blowing numbers out. They're raising dividends, and they trade at 5, 6, 7 times earnings with no debt. I mean, this is the most undervalued group in the market, and nobody seems to care right now. So the deal is, I do own this group. 1, because it's an inflation hedge. 2, because it's the cheapest thing out there relative to cash flow, earnings growth, revenue growth, and asset growth. And so, yes. And by the way, Bitcoin.
Yes. No, I want you to talk about Bitcoin just 30 seconds. If you had to give advice to my daughter, who's, in that millennial range, talking about Bitcoin, I've tried to get her to be very, very cautious of that. You?
I like it in a lot of ways, and I own it. Okay. But it is, and right now it's taken the sizzle away from precious metals. The same type of people that would worry about these things I'm articulating here are in Bitcoin, and it's cooler than cool. However, it is a narrow market, meaning that it's not a very deep market. And the gold market is huge and deep and international. 1, central banks don't buy Bitcoin. They do buy gold. 2, gold is a legitimate reserve asset. You can lend against it and borrow against it, according to Basel III rules, which are the new international monetary rules. And so because of that, it's a much better play. But I do like Bitcoin, I must admit.
But you put it in your high risk bucket, right? Would you not?
Oh my gosh, yes. I've got my foot on the brake on Bitcoin,
okay,
and unfortunately on the gas and precious metals, because I'm not being rewarded yet, but I promise I will be.
Words of wisdom from Thomas Landstreet. Thomas, thank you very much. If people want more information about what you do, where should they go?
Well, we have a website, www.trustco.com, and I'm on Twitter at tlandstreet, and I'm often pontificating or, getting over my skis, being snippy about other people's comments on Twitter. So you can find me there.
All right. Very good. Great advice. Great talking to you. And we'll see you down the road. We'll see what happens. We'll check in with you maybe in about a couple of months and see how things are going in the economy. All right.
Thank you so much.
Thanks, Thomas.